Hey, good morning. I am somewhere along the highway picnic area in the Great Smoky Mountains on the North Carolina side. It's a beautiful area, beautiful, cool morning. I thought it was a good time to stop and talk a little bit, maybe give some information about taxation of crypto, taxation of cryptocurrency. So let's start with the first thing being that even though it's called cryptocurrency, the IRS does not recognize it as a currency. The United States government and really very few governments recognize cryptocurrency as currency. So for U.S. tax purposes, cryptocurrency is property. This means that if you buy property, you sell property, you are reporting a gain or loss on the sale of property, regardless of how you use the cryptocurrency. This is something that a lot of people don't understand, maybe even some tax preparers don't understand. So I'm seeing this quite a bit, even with my more high-end tax clients who I prepare tax returns for. I prepare a few high-end tax returns, more complicated ones, trust returns, and that sort of thing. Taxation of cryptocurrency is treated similar to a stock transaction, probably the best example. So a stock transaction would be I buy a share of Tesla, I sell a share of Tesla, and I have capital gain or loss between what I bought it for and what I sold it for. If I sold it for higher, I have capital gains. If I sold it for less, I have capital loss. And then whether it's short-term capital loss or long-term capital loss, that's going to be determine how long I held it. If I held it for a year or more, then it's going to be long-term capital loss. If I held it for less than a year, it's going to be short-term capital loss. So let's apply that to cryptocurrency. If you bought a Bitcoin at $35,000 and you sold it at $20,000, let's use that transaction. If you bought a Bitcoin at $35,000, your cost basis is that $35,000 plus whatever your transaction cost, your cost of acquisition. So let's say that's $100, and your cost basis is then $35,100 on that Bitcoin. And let's say you sold it at 20, you panicked out and sold it at 20, and you had a transaction cost of $100. So you had a cost basis of $35,100, you have a proceeds of $20,000 minus the 100 or $19,900. In this case, you would have a capital loss for the difference between $19,900 and $35,100. If you held it for less than a year, it'd be a short-term capital loss. If you held it for longer than a year, it'd be a long-term capital loss. That's a pretty simple transaction, and the simplest of transactions. And so, at the end of the year, typically you'll get some kind of transaction report from whoever you're using for your cryptocurrency transactions, whether that's FTX, Robinhood, Coinbase. And sometimes you'll be issued a 1099-K. A 1099-K simply reports to the IRS what the proceeds of your cryptocurrency sales are. A lot of it's just that. It's just, here's the proceeds. It doesn't give cost basis. It typically won't. And so you have to keep track of that. So at the end of the year, you get a 1099-K, or you don't, and you report all of your sales of cryptocurrency on Schedule D of your tax return. Schedule D of your tax return is where you report capital gains or losses. That's your simple transaction. Your more complicated transaction that you're starting to see as it's being used in commerce as a currency, use the example of, you bought a pizza and that pizza was, $35, and you are selling a fraction of a Bitcoin for that pizza. So you go on your wallet and you send 0.0001 or whatever it is of a Bitcoin to the pizza place. You get a pizza. What has just happened? You didn't spend that fraction of a Bitcoin, you actually sold that fraction of a Bitcoin. And this is where it gets complicated, and I think that very few of these transactions are being reported on tax returns. And so that is that you sold that fraction of a Bitcoin. You have to figure out what your cost basis is on that fraction of a Bitcoin, and then you sold it for the $35, so you'll also have that's your sales proceeds. So that's, once again, as you can see, that's a pretty more complicated transaction that's going to become more common. And so how you handle that, how you report that, And more practically speaking, how the IRS starts to enforce that is probably interesting. I'm not saying the IRS is either equipped or interested in trying to tax the fractional Bitcoin purchase of pizza, but the IRS gets interested in the weirdest things. So it certainly is coming as those transactions grow in value and the tax loss from those transactions mount. There'll be not only bureaucratic pressure, but political pressure to collect tax on those transactions. So that's your taxation of Bitcoin. You have it's property, not currency. Whenever you either sell a piece of cryptocurrency or you use it in commerce, that's a sale. You either going to have a capital gain or a capital loss. That is the spread between whatever you paid for it, your cost basis plus acquisition costs, transaction costs, and those sort of things. The difference between that and your proceeds, which is what you sold it for or what the value you got in commerce. The 1099-K is something that is an IRS required form that has to be filed by whoever are custodians, and this would be your Coinbase, your FTX, your Robinhood. Obviously, if you're just doing wallet-to-wallet transfers, there's nobody there to report a 1099-K. But the important thing is that the 1099-K is not what makes the transaction reportable. It is reportable because there's gain or loss. And so I run into this, even on the gig economy or on, self-employed people all the time, where just because they didn't get a 1099, they think it's not taxable. That's not the case. The likelihood of getting caught is not high, but that's not the standard. And if you do get caught and you aren't reporting these, there can be pretty stiff penalties, up to a civil fraud penalty of 75% of the tax. So try to really figure out how to best keep track of the transactions. Some people use a spreadsheet. Coinbase Pro is getting better. Coinbase Pro. Robinhood does a pretty good job, I've seen, of showing total transactions, total gain or loss, when you bought it, when you sold it, that sort of thing. So that's going to be helpful. So I hope that's helpful. Number one, cryptocurrency is property, not currency. When you either sell it or have a transaction, it's capital gain or capital loss. You report it on Schedule D of your tax return. Once again, hope that's helpful, and I will talk to you next time. You have a good day.